Let's take the second company, Apple. Let's start again with the income statement. We have the revenues, cost of revenues, and gross profit revenue. We took in 2021 the total revenues, we took the cost of revenues, that is the cost of sales, and we got the GP margin. From this GP margin, the GP margin comes out to be 41.78%. Then we calculate the operating revenues. How we calculate the operating revenues? As usual, we deduct the operating expenses and we get the operating revenue of around $109 billion. Our operating revenue is $109 billion. Operating margin is 21.52%. Now, Apple has a much lower operating margin as compared to Google. Why is that? Because Google is inherently a service company and Apple do provide service but is inherently into products. That is, it's iPhones and etc. So Apple has a much higher operating margin. So Apple has a low operating margin than Google. Now the net income is $94.68 billion and the net margin is again net income divided by revenues, that is 25.88%. The income tax rate of Apple is 13.3%. How did I calculate it? Very simple. I took the net income, that is, I took the income before tax, that is $109 billion. We took the taxes, $14 billion. 14 divided by 109 gives me 13.3% income tax rate. Now the free cash flow from operations, how do you calculate that? We go to cash flows. In free cash flow operations, we first find out it's here cash generated by operating activities, that is $104 billion. From this, we deduct what? We deduct the acquisition of plant, property and equipment, $11 billion. Is there any acquisitions? There has been no acquisitions. So the capex is $11.1 billion. Free cash flow after capex is 92.93%. So which is almost equal to the net income. So free cash flow to revenues is 25.40%. Finally, we come to balance sheet. What do we do in balance sheet? In balance sheet, we have equity. Our equity is at the end, that is $63 billion. We take our equity from debt. From debt, we have long-term debt and short-term debt. In long-term debt, we have the term debt. In debt, in balance sheet, we look at short-term and long-term debt. In long-term debt, $109 billion of term debt, and in short-term debt, we have other current liabilities and term debt, which comes out to be around $57 billion. Total debt, $166 billion. Cash and marketable securities is around $35 billion. That gives us an invested capital of $194 billion. How we calculate return on equity? Return on equity is only $63 billion, and we take the net income from that, that is $94 billion. The return on equity of Apple, my dear friends, is 150%. And that is one of the major reasons Warren Buffett had invested in this company. Why so high? Because whatever money Apple is earning, it is using majority of it for share buyback. Share buyback reduces the equity and you increase your return on equity. Return on invested capital of Google, for that we just have to find out the invested capital. Invested capital of Apple is 194.25. We take the operating income and we reduced our income tax rates and we finally got our operating income after tax divided by our invested capital and we get return on invested capital of 48%. Now, when it comes to reinvestments, there is something which happens very interesting in the case of Apple. The net capex is actually negative. How? Well, the capex of Apple is $11.1 billion. Out of this capex, what we are deducting? We are deducting the depreciation. That is actually resulting that Apple has actually not invested any amount when it comes to in your capex. It has just invested whatever repair and maintenance was required, as depreciation is a proxy for that. In the change in non-cash working capital, it's only Apple has invested $5 billion of its capital only. So reinvestment is quite low, 4.33%. So let's continue with the example. And yes, I have changed my shirt. Let's continue with a company which we love to hate. Again, we start with Meta Platforms Incorporated, 2021, year ended 31st December 2021, $118 billion almost of our stolen data revenue. The cost of revenues Of course, everything is software driven. It's a platform. Cost of revenue is almost nil, 22 billion. GP revenue is 95. GP margin highest in any of the companies we are looking at, more than 80%. Operating revenues, excellent again, is around 40%. How do we calculate operating revenues? We deduct all these expenses, obviously, and we got operating revenues, operating margin around 40%. Our net income that is $39.37 billion. That gives a net profit margin, a very high profit margin of 33%, highest than Alphabet and Apple. Income tax rate, very simple again. We took the provision for income taxes and 7.9 divided by 47.2, that is 16.73 tax rate. Free cash flow from operations. We go to cash flows. $57 billion cash flow from operating activities minus 18.567 and to 8.51 acquisitions. That gives me capex of 27.06. That gives me a capex of 19.41 and free cash flows 38.27. Free cash flows to revenue very, very high of 32%. Again, highest in Alphabet and Apple actually. Now we comes to the balance sheet. In the balance sheet, we have equity. Equity is $124 billion. Debt, short and long. We have short-term debt of accrued expenses, $14 billion. And long-term operating lease liabilities and other liabilities of almost $20 billion. So we put those figures in this and we got our total debt of $48.11 billion. Our cash is 16.6, invested capital, equity plus debt minus cash, that is $156 billion. Return on invested capital, we take the operating income, that is 46.75. If you multiply it with the income tax rate, 1 minus income tax rate to get operating income after tax, divide by invested capital into 100 to get return on invested capital of 24.89%. Now comes our net capex to find our reinvestment. Where do we go? We go back to cash flows. In cash flows, we go back to cash flows. We find out what? Our capex. We know what is our capex, 18.567 and 851. We reduced from this our depreciation, and that depreciation is around $8 billion. So we give net capex $11 billion. Change in non-cash working capital. Now Facebook is actually managing its working capital quite well, but it's still resulting in investment of around $700 million. How I found out? We basically take all of these figures, change in assets and liabilities, and we take the net amount from this. This is operating profit before operating cash flows before working capital changes. So this is working capital changes of Meta. We take this net figure, all of these amounts of net figures, and these net balance comes out to be, has been $700 million actually been taken out of the company, because it's actually a negative figure. So negative and negative means positive. So that means reinvestment of Facebook is actually not 11.51. It's lesser than that. It's $10.81 billion. Reinvestment is 23%, which is a healthy reinvestment rate. And finally, we come to one of the most overhyped companies on earth right now. That is Tesla, of course. So Tesla's revenues is $53 billion, a very small as compared to our other FANG stocks to say. The cost of revenues is just above $40 billion. That gives a gross profit of $13.6 billion. Our operating expenses are $7.8 billion. Our income from operations, that is operating income, is around $6.5 billion. All of these figures have been put here. Revenues, cost of revenues, GP revenue, operating revenue. GP margin is lowest of all of them, only 25%, because Tesla is making cars. And cars are very expensive to make as compared to what? As compared to, let's say, Facebook's likes, or Facebook's increase in, or Facebook's advertising, or Apple advertising, or even small things like Apple iPhones. Cars are extremely expensive to make. Who knew, right? So GP margin is just 25%, lowest of all these stocks. Operating revenue is only $6.5 billion from $53 billion. That is, operating margin is just 12%, just above 10%. That's it. Net income is $5.64 billion after taxes. Net margin is around 10%. Income tax rate. How we calculate? Tax paid before tax, that comes out to be 11.02%. Now all these income statement figures have been taken. Let's calculate the balance sheet figures. Let's calculate the cash flow figures. In cash flow, Tesla's cash flow from operations, that is around $11.49 billion. And from investing, that is around $6.48 billion. $6.4 billion. And purchase of retail assets and sale of digital assets, net of these figures, and purchase of solar, purchase of retail, proceeds from sale. All these four figures will be used because these are all capex. The net figure is around $7.74 billion. Free cash flows after capex, this minus this, $3.75 billion only. Free cash flow to revenues is only just 7%. Extremely low figure. That's why I say everyone keeps on talking Tesla is going to do this, Tesla is going to do that. But this is what you can see is the real figure or real picture of Tesla. It's a good company, no doubt about it. But right now, it does not justify its valuations. It does not justify such a high price for its stock price. Then we comes to the balance sheet. Equity of Tesla, $30 billion. Debt, short-term and long-term debt. For short-term and long-term debt, we have accrued liabilities of around $5.7 billion, and we have other long-term and debt and financial leases of $5 billion and $3 billion in deferred revenues. That comes out to be around long-term debt of $5.2 billion. We have long-term debt of around $8.7 billion, total debt of $15.9 billion. Cash and marketable securities is $17 billion almost. Invested capital, equity plus debt minus cash, it's $28 billion. Return on equity is respectable. That is the net income divided by equity. That comes out to be around 18.69%. And return on invested capital comes out to be, after taking all the debts and invested capitals and the tax rates as we are doing before, it comes out to 22.29%. Of all the four stocks, the highest valuation is given to Tesla, but in reality, they have got the lowest financial parameters when it comes to understanding your business. Financial statements cut through all the hype and tells you what's the real picture of the company, as we can see here. For net capex, again, we take the depreciation figure minus 2.9911 and we take the capex, we deduct it, and we got the depreciation figure of net capex of 4.83. Change in non-cash working capital, we take all these figures. Change in operating assets and liabilities, all of these net figures comes out to be 0.52, $520 million have been invested in working capital. Reinvestment is 5.35. Almost all the operating income is being reinvested back into business because Tesla is a much more growing company as compared to these companies. They are quite mature in their life cycle, but Tesla is a very, very young growing company still. Finally, we have done the financial statement analysis of 4 of the biggest companies in the world. I hope by taking all of these financial statement analysis, by learning to understand and read your business as well as the financial statements of such big businesses, I was able to teach you a valuable skill which will help you in all your life. Thank you for listening to me. I hope that these skills will help you in your career. I hope I was able to make a difference in your life. Thank you.